Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today, we're looking at energy fuels.
If you find our talks useful, please consider subscribe, like, and comment underneath. It really helps us out. So today is Friday, February 20th, 2026. And we are looking at a company that is it's absolutely tearing up the charts this year.
Yeah, tearing up the charts is honestly an understatement.
Yeah.
This isn't just your standard, run-of-the-mill energy play. This company is sitting right at the intersection of two of the most critical supply chains in the world today.
Right. Nuclear energy and rare earth elements.
Exactly. And those are two sectors that have massive, massive secular tailwinds right now.
I was actually looking at the performance numbers this morning before we sat down, and I honestly had to double-check my screen. The stock is up over 184% year to date.
Just incredible momentum.
And we're only in the middle of February. I mean, the wider industry is up maybe 38%, which is obviously great on its own.
Sure, 38% is a fantastic year for any normal sector.
Right. But energy fuels is just operating in a completely different stratosphere right now. So the main question on my mind, and I'm sure on the minds of everyone listening to you right now, is pretty simple. Is this just retail hype, or is the underlying engine really just getting started?
That is the million-dollar question. And to really answer it, we have to pop the hood and look directly at the fundamentals. Because if you just glance at the top-level headlines, you might actually walk away with a pretty confusing picture.
How so?
Well, there is a massive, undeniably huge growth story happening here. But there are also some serious growing pains. And we need to be really honest about those if we're going to build a solid thesis.
Okay, let's start with the growth then, because I saw a revenue figure that basically blew my mind. For the third quarter of 2025, their revenue surged 338%.
Yep.
I mean, that is a gargantuan number, and that's mostly driven by them just moving increased volumes of uranium, right?
It is. They are moving serious volume. But, and here's the crucial nuance that you really have to understand, that revenue surge came with a very heavy price tag.
Okay.
Because while the top line exploded, their cost of sales went up by nearly 600% in that same window.
Wait, hold on. Revenue up 338%, but the cost to get that revenue went up 600%.
Exactly.
That sounds like an absolute recipe for a margin disaster. It feels like you're selling dollar bills for 90 cents just to show high sales volume.
It was a margin disaster, temporarily. The gross margins contracted significantly. If you look year over year for that quarter, they dropped from about 54% all the way down to 28%.
Ouch. I mean, 54 down to 28 is a very steep drop for a company priced for growth. So they are selling way more material, but keeping vastly less of every single dollar that comes in the door.
Why did that happen? Was it just general inflation hitting the mining sector or something specific to them?
It comes down entirely to what they were actually putting through the mill. Think of it kind of like running a bakery.
Okay, I like a good bakery analogy. Right, so if you're baking bread with flour that you bought on super discount last year, your profit margin on every loaf is going to be huge.
Because your input costs are practically zero.
Exactly. But let's say you run out of that cheap warehouse flour. And to keep the ovens running and fulfill your orders, you suddenly have to go buy premium imported flour at sky-high spot prices.
Your revenue from selling the bread looks exactly the same, or even higher if you sell more.
Right, but your profit crashes. And that is exactly what Energy Fuels was dealing with. They had much higher per pound costs during that specific period because they were processing purchased feedstocks. They had to buy material rather than processing their own cheaply mined ore.
Ah, okay. That makes perfect sense. So they were basically churning through really expensive inventory just to meet delivery volumes.
Precisely.
But look, the stock is rallying incredibly hard right now. So the market clearly must believe that the cheap flour is coming back into the bakery.
You hit the nail on the head. And this is exactly where the turnaround strategy comes into play. It's the whole reason the market seems to be completely forgiving that recent margin compression. It is all about the Pinyon Plain mine.
Pinyon Plain. Yes, I've seen that name popping up in almost all the recent analyst reports. It sounds like the hero of this entire narrative. What makes this specific mine so important to the bottom line?
It is all about the grade of the ore. In the mining and milling world, grade is absolutely king.
Because higher grade means you process less useless rock to get the same amount of finished uranium.
Exactly. It saves on time, chemicals, energy, everything. Energy Fuels actually started mining at Pinyon Plain back in Q4 of 2025, and that production campaign is running right through this current quarter, Q1 2026. This is incredibly low-cost, high-grade ore.
So instead of going out to the spot market and buying expensive raw material to feed the mill, they are finally digging their own premium low-cost product out of the ground.
That's the pivot. The strategy is to process this specific high-margin feedstock to drive those gross margins right back up to where they should be. They are officially targeting something between 1.1 to 1.4 million pounds of finished uranium from this specific campaign.
Okay, so if I'm piecing this together correctly, the margin squeeze we saw late last year was basically just a blip. It was caused by expensive inputs, and now Pinyon Plain is the cheap fuel that fixes the profit machine going forward.
That is the core bull case on the fundamentals right there. They aren't just out there digging random dirt. They are executing a strategic pivot to a much more profitable fuel source, and they are doing it right now. And if you zoom out and look at their broader financial health, the company is in a remarkably sturdy position to actually pull this off.
Yeah, I did notice the balance sheet looks incredibly clean for a company in this sector. I mean, trailing 12-month revenue is up over 103% to roughly $78 million.
It's a solid base.
But what really stood out to me was the debt situation, or I should say, the complete lack of it.
That is a massive differentiator. In the mining and mineral processing world, these companies usually just drown in debt to fund their expansions.
Right, because you need hundreds of millions of dollars before you ever sell an ounce of metal.
Exactly. They take out massive high-interest loans to build mills or sink new mine shafts. But Energy Fuels has very low debt, and they actually have positive free cash flow. They have these fully licensed operating uranium facilities that are generating cash today.
Which means they can self-fund.
Right. It allows them to fund all these critical mill upgrades and buy necessary feedstock without having to go beg the banks for a loan.
Or, honestly, what's even worse for retail investors, issuing a ton of new shares and diluting everyone.
Yes. Dilution is the absolute silent killer for mining investors.
You buy stock, and then 6 months later, you suddenly own a significantly smaller percentage of the actual company because management had to print 100 million new shares just to keep the lights on.
Exactly. But here, they are completely self-funding their growth cycle.
Which is incredibly rare for a company growing top-line revenue at over 300%. Usually, hypergrowth is entirely funded by hyperdilution.
And you also have to note that they aren't paying out dividends or doing stock buybacks either.
They're hoarding the cash.
Every single cent of that cash flow is going right back into expansion. They are actively building a war chest for growth, not trying to pay out a tiny yield to income investors.
Which makes total sense when you look at how the market cap has exploded. The company is now valued at roughly $4.87 billion. That reflects a 366% growth in valuation. The market is clearly pricing in total future dominance here, not a quarterly dividend check.
And that concept of dominance brings us perfectly to their competitive moat. You know, I always love looking for wide moats, those structural advantages that make a business nearly impossible for a competitor to copy.
Oh, absolutely.
Well, Energy Fuels has something that I would genuinely classify as a unicorn asset.
You're talking about the White Mesa Mill in Utah.
I am. It is the absolute crown jewel of the entire company.
Mm.
You have to really understand the regulatory environment in the United States to grasp this. You can't just go buy a plot of land and build a uranium mill in your backyard today.
The permitting alone would take a lifetime.
The permitting, the environmental regulations, the local pushback, it's practically impossible. It takes decades of legal battles and hundreds of millions of dollars in sunk costs. And even after all that, the government's answer is usually just a flat no.
So having a facility that is already fully built, completely licensed, and actively running is a nearly insurmountable barrier to entry for any new competitor.
It's massive. But that's not even the best part. White Mesa is the only existing facility in the entire United States that has the capability to process both uranium and rare earth elements.
Both of them in the same facility. So they can do the heavy nuclear fuel side and also the critical materials we need for things like EV magnets and advanced defense tech.
Correct. And that duality is why the strategic value of this company is off the charts right now. We constantly hear politicians and industry leaders talking about supply chain independence, right?
Yeah, the whole push to stop relying on China for everything critical.
Exactly. Energy Fuels has quietly built a completely vertically integrated China-independent chain. They handle the mining, they handle the heavy processing, and they have developed this proprietary tech to efficiently handle really complex materials like monazite,
Monazite. I've definitely heard that term thrown around in the rare earth space. It's essentially an ore that contains a huge concentration of rare earths, right?
It is. It's a type of mineral sand that is incredibly rich in the exact rare earth elements the world is desperate for. But there's a massive catch that keeps most companies away from it.
Let me guess, it's highly toxic.
Even better, it's highly radioactive. It naturally contains significant amounts of thorium and uranium.
Which means your standard run-of-the-mill rare earth processing plant legally cannot even let a truckload of monazite through their front gate.
Exactly. Most rare earth companies look at a pile of monazite and see a massive radioactive regulatory liability. Energy Fuels looks at that exact same pile and sees a dual revenue asset.
Because they already have all the licenses to handle radiation?
Right. Because they are fundamentally a uranium miller first, they can take that monazite sand, extract all the natural uranium out of it, which they turn around and sell into the nuclear market, and then safely process the remaining rare earths.
That is just a brilliant business model. They are literally turning the most problematic part of the ore into a secondary high-margin revenue stream.
Precisely. And they have actively secured access to these heavy mineral sands in places like Madagascar, Brazil, and Australia.
So they can ship that raw material directly to Utah, run it through their proprietary process, and produce finished critical metals right here in America.
If you are a competitor trying to replicate that supply chain from scratch, where do you even begin? You don't. Good luck to anyone trying. The switching costs and the barrier to entry are just incredibly high, especially when you compare them to pure-play rare earth peers like MP Materials or Linus, who have completely different and arguably more vulnerable exposure profiles.
So they are effectively the only game in town for this dual processing capability in all of North America. When you frame it like that, it completely explains why the stock chart looks like a SpaceX launch right now. Let's actually pivot to that technical analysis because the price action is really fascinating to dig into.
It's genuinely historic price action. Like we mentioned earlier, the stock is up 184% just this calendar year. The first few months of 2026 have been incredibly kind to their shareholders.
But it hasn't been just a perfectly straight lineup, though. I saw it close at $20.29 on Tuesday, February 17th, and there was a little bit of a dip recently, maybe around 2%.
Right, but honestly, that dip is very healthy market behavior.
You don't want it going straight up every single day.
Exactly. When a stock runs this hot for this long, you actively want to see some cooling off. A perfectly straight lineup almost always ends in a catastrophic crash.
Yeah.
You want to see periods of consolidation. You want to see early buyers taking some profit off the table.
It builds a new floor of support.
Right. And just look at the longer-term range. The 52-week low for this stock was $3.20. The 52-week high was almost $28.
Wow.
So even with a small, healthy pullback to the $20 level, the underlying psychological strength there is just massive. Investors are holding on to these massive gains because they believe in the long-term thesis.
And we should talk about who exactly those investors are, because looking at the options volume this week, it really smells like big money is getting heavily involved.
You're spot on. We are seeing unusually high options volume across the board for this ticker. That kind of flow tells us that major institutions are actively positioning themselves for volatility, but more importantly, they are front-running a massive sector rotation.
So big funds are taking their profits out of, say, big tech or consumer goods and hunting for the next big secular trend.
Exactly. And that capital is flowing like a river into uranium and rare earth plays.
It really feels like a classic technical breakout. Like the broader market is just finally waking up to the stark reality of the global energy and materials deficit.
It is a textbook breakout. The stock recently smashed through to multi-month highs. And a lot of that immediate momentum is actually being fueled by some intense acquisition buzz.
Oh, really? Who are they looking to buy?
Well, there are credible rumors swirling around the desks right now that Energy Fuels might be aggressively looking to acquire more upstream assets to accelerate that rare earth capability we talked about. They want to lock in more of that raw material supply.
Well, speaking of serious market buzz, we have to talk about the Goldman Sachs effect. Because that news just dropped yesterday morning, February 19th, and it moved the needle.
Yes, this was a major, major catalyst for the stock this week. Goldman Sachs officially initiated coverage on Energy Fuels. And look, love them or hate them, when Goldman talks, the entire market stops to listen.
What was their actual take, though? Because sometimes these big investment banks come incredibly late to the party and just publish a report stating the absolute obvious.
They are incredibly bullish. They basically highlight everything we just spent the last 10 minutes discussing, specifically the absolute uniqueness of that White Mesa mill. They stated that Energy Fuels has the real potential to supply a highly meaningful portion of the entire U.S. domestic demand for rare earths by the year 2030.
By 2030, that is a massive claim from a major bank. That effectively puts them at the absolute dead center of the U.S. national industrial strategy.
It really does. But the milling capacity is genuinely there to back up that claim. And because of that strategic position, Goldman sees about 50% implied upside from the current price levels. They are aggressively pounding the table on this stock right now.
And that seems to align perfectly with the broader street consensus, too. I checked the aggregate analyst ratings this morning, and it's basically a unanimous strong buy across the board. You've got 6 major analysts covering it, and their price targets are ranging from roughly $19.80 on the low end all the way up to nearly $27.
Which means the current pullback price is sitting right in the middle of that institutional buy zone. But we have to be objective and balanced here. It is not entirely sunshine and rainbows for the next few days. If you look at the financial news headlines this morning, there is a very real tug-of-war happening with the sentiment.
Yeah, I did see that. On one hand, you have this massive Goldman Sachs hype train, but on the exact same page, I saw a pretty bearish headline asking, will Energy Fuels report negative earnings next week? That feel like a bit of a wet blanket on the whole rally.
It definitely creates a very mixed short-term sentiment picture. You have all this institutional excitement about the long-term critical minerals monopoly play, and then you have the day traders and short-term algorithms panicking about next week's quarterly earnings report.
Which brings us perfectly to the catalyst calendar, because next week is going to be incredibly pivotal for the price action.
Mark your calendars for Wednesday, February 26th. That is the official date for their next earnings release.
So as an investor holding this stock, what should you actually be bracing for on Wednesday morning?
The street consensus currently suggests that we might actually see a negative earnings per share, or EPS, for the quarter.
A negative EPS. Okay, normally, a hyper-growth company reporting a loss completely tanks the stock, doesn't it? If I'm just a regular retail investor and I wake up, check my phone, and see a headline that says, Energy Fuels loses money, my first instinct might be to panic sell.
In a normal, rational market environment, yes, a negative EPS is bad news. But here's the most critical piece of advice for anyone listening to this right now. You have to look right past that headline EPS number on Wednesday. If they report a paper loss, do not panic sell immediately. You need to read the actual release and listen to the guidance.
What specifically are we looking for in that guidance?
The production updates. Remember what we said earlier about the expensive flour versus the cheap flour at the bakery?
Right, the spot market inventory versus the Pinyon Plain mine ore.
Exactly. The Q4 EPS number they report next week is going to reflect the past. It's going to reflect the cost of that expensive stuff they already burned through. As forward-looking investors, we need to look at the future. We need to look for confirmation that they are fully on track to produce that 430,000 to 730,000 pounds of finished uranium in this current Q1 2026 quarter.
We basically need tangible proof from management that the Pinyon Plain ore is actually flowing and improving those unit margins as promised.
Exactly. The thesis is simple. Ignore the rearview mirror and focus entirely on the windshield. If those forward production numbers are strong and the margin guidance is up, the institutional market will likely completely ignore a messy, backward-looking EPS number.
And when you look out that windshield at the macro drivers, the view is spectacular. Just recently, we saw the first U.S. nuclear fuel license issued in 50 years. That single event is spurring a massive nationwide race to secure domestic uranium.
It really is a paradigm shift. The regulatory environment has completely flipped on its head.
Yeah.
For 50 years, nuclear energy was basically a dirty word in Washington. Now, it is officially recognized as essential, clean baseload power for AI data centers and grid stability.
Plus, you have all those massive government subsidies and incentives for EVs and defense minerals, providing a huge multi-year tailwind for the rare earth side of their business, too.
The macro environment has literally never been better for a company structured exactly like this.
Okay, I agree with all of that. But I am going to play devil's advocate for a minute here. We have to clearly lay out the risks. What could actually go wrong and break this thesis?
The single biggest risk is right in front of us next week. Short-term earnings volatility. We already know for a fact that margins were heavily compressed late last year. If the operational ramp-up at the Pinyon Plain mine hits some kind of unexpected snag and maybe technical milling issues, or maybe the ore grades are coming in lower than their geologists expected and management has to announce a delay next week, the stock will get absolutely punished.
Because the valuation is sitting at nearly $5 billion right now. It's heavily priced for perfect execution.
It is entirely priced for execution. Any operational slip-up will trigger a violent sell-off. And secondly, you have to consider commodity sensitivity. Remember that little 2% dip we discussed earlier, the one that happened while the broader tech market was actually gaining?
Yeah.
That specific divergence shows that this stock is still highly, highly sensitive to the underlying spot price of uranium.
Right, because if the global price of uranium suddenly softens, their profit margins get squeezed immediately, no matter how good or cheap that new mine is.
Exactly. At the end of the day, Energy Fuels is a price taker, not a price maker. They cannot control or set the global market price of uranium. So as an investor, you are inherently exposed to the wild volatility of the global commodity markets. If uranium suddenly drops back down to $60 a pound, their entire internal math changes overnight.
Okay, so it's a high-stakes, high-reward setup. Let's try to boil all of this down to a final verdict for the listener. What is the ultimate investment thesis here?
For me, looking at the full picture, the bullish score is a solid 8 out of 10.
An 8 out of 10. That is a very confident rating for a mining stock. Walk me through the quick elevator pitch.
Here is the pitch. Energy Fuels is not a swing trade. It is a multi-year hold, targeting that 2030 supply chain crunch. Why? Because they are literally the only game in town for dual uranium and rare earth processing inside the United States. A competitor cannot replicate their physical asset base no matter how much money they have.
The moat is as real as it gets.
The moat is massive and fully licensed. Secondly, the necessary pivot to low-cost production is happening right now with the Pinyon Plain ore. This isn't some speculative pie-in-the-sky story about a mine they might build in 5 years. The ore is physically in the mill today.
And the balance sheet protects the investor while they process it?
Exactly. Third, their incredibly low debt profile allows them to aggressively fund all this expansion without diluting your shares into oblivion.
Which is such a huge, often overlooked factor for long-term holders in this space.
It really is. And all of this underlying strength actually turns that near-term earnings risk we talked about into a potential opportunity. If the stock takes a harsh emotional dip on a messy headline earnings report next Wednesday, but management confirms the long-term production story is fully intact, that becomes an incredibly high conviction entry point for a long-term position.
So if you know what you hold, volatility is actually the friend of the prepared investor here.
Absolutely. You use the market's short-term panic to build your long-term position.
I love that. It really frames the upcoming week perfectly.
No.
You know, as we wrap this analysis up, I'm left thinking about the much bigger picture you painted today. We are rapidly moving into a world where energy independence and material independence are basically synonymous with national security.
It is absolutely going to be the defining geopolitical theme of this entire decade.
And with the U.S. government pushing so incredibly hard to onshore that independence, it raises a pretty provocative question for everyone listening to ponder. Can any other company actually navigate the decade-long regulatory nightmare required to catch up to White Mesa's dual capability? Or are we essentially looking at Energy Fuels becoming a government-backed monopoly for North American critical minerals?
That right there is the multi-billion-dollar question. Because if they execute on this current pivot, they could virtually own the domestic supply chain by 2030.
Definitely something to mull over as you watch the charts and wait for those numbers next Wednesday. That is all the time we have for today's analysis into Energy Fuels.
Thanks for listening, everyone. Remember, keep your eyes focused purely on those forward production numbers next week, not the backward-looking EPS.
Great advice, and we will catch you all next time on Smart Wealth with Joshua.